From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first Friday of 2025. Well, the holidays are just over, and we're back in our places with bright, sunshiny faces. Well, most of us anyway. So let's check the calendar. Your Milwaukee Bucks are home tomorrow night with the Trailblazers, and it's Bear Week in Green Bay. The Packers welcome the not-so-very-good Chicago Bears to Lambeau this Sunday afternoon. All right, let's get started. 3 people were injured over the weekend when a flaming adult beverage blew up. It goes without saying you're supposed to blow out the flame before you drink your volcano. I didn't think I needed to warn anybody about that. Virtual reality can be had with virtual reality goggles, but some scientists just have too much time or too much funding, so they've developed teeny tiny VR goggles for lab mice. That's right, lab mice. And as a side note, the mice have gotten really good at Call of Duty. The autopsy of a 35-year-old man was more than a little strange. They discovered a live baby bird lodged in his throat. The thinking was it was part of a fertility ritual. Well, now he's really not going to have any kids. And finally, a Maryland man was arrested for disrupting 2 Christmas services by pouring whiskey into the holy water. At the next baptism, all the babies are going to need fake IDs. On the podcast today, we have Tom Pappenfuss, Joel Driesing, and wrapping up the week, here's Kyle Tedding.
Well, thanks, Max. Happy New Year to all. The Nasdaq started the year up 1.6%, but down on the week, 0.5%, down 100 points this week, closing at the bell on Friday at 19,622. The S&P 500 down 0.5% this week. Although, again, 2 days into the year, up 1%, closing at the bell at 59.42, and the Dow Jones Industrial average down 0.6% for the week, up 0.4 on the year so far, closing at 42,732. Benchmark 10-year U.S. Treasury ending the week at 4.59%, far higher than where we've been, but certainly I think within the realm of maybe where we thought we'd end the year and kind of start the new year. You know, Tom, hard to maybe not start the podcast today with a bit of a look back at some of the returns from 2024. Such a compelling year overall, the second consecutive 20-plus year for the S&P, the first time really in the better part of a quarter century. Tough not to be upset about another great year for stocks.
Yeah, I'd say quite surprisingly and, very much welcomed by us all. Very strong returns again this year. Interesting year in that I think a lot of, the market run-up I think what gave me a lot of optimism as prices kept going higher was that it was not an overly loved market bull run. I'd say, you look at investor sentiment throughout most of the year, it was largely still fairly negative. And as I've commented before, and I'm sure other people on this podcast have noted that many, many months, especially in recent months, where people are still adding money to money markets and taking advantage of CDs and higher yields. And again, that's a fairly positive sign that, to me, there is still more room to run. But yeah, you look at the returns and it's interesting to note that we saw a year where we saw more market breadth. I think that was really important to see, to give us more confidence that this market is healthy. And again, generally a sign of more sustainability with returns. But, I think in recent weeks, after the election, we removed that one level of uncertainty, that I think kept a lot of people, a lot of investors at bay. A lot of that money kind of flowing into the money markets. And we saw, markets kind of take off again. And then I saw, in my view, kind of more of a return to some of the dynamics of the market. You saw the technology, the communication services sector start to lead off, because up until that point, I think a couple months ago, utilities was one of the top performing sectors on the year, kind of an AI energy play, if you will. And, we saw financials do very well. And a number, industrials had a very nice year as well. But then just the last few weeks, we really saw those kind of everyone going back to some of those strong technology, high, a more aggressive type of approach, and seeing those returns really explode.
I remember entering 2024 with a lot of folks talking about small cap finally going to see its day in the sun, value stocks finally going to see their day in the sun. And there were certainly points in time last year in which that was the case. I think a weaker finish in both of those instances maybe hid some of what was otherwise an okay year. Of course, we don't get to just say, well, it was great up until it wasn't. We've got to look at kind of the full year for it, and the fourth quarter being a bit of a challenge on both the small cap side and the value side is certainly part of the return series. But I think it was encouraging that at points in time in which the market was functioning well, when investors were being, I would say, a bit more discerning about where they wanted to take risk. You rightfully point out utility stocks last year. Well, that's a traditionally pretty defensive sector, dividend-focused, value-focused. And to see returns on the year north of 23% for the utility sector, I think is a pretty compelling place to get some potential return. Yeah, not quite S&P 500 kind of middle of the market returns, but still quite strong. And so, I think continue to see plenty of opportunity in the banks and the technology sector and communication services. But at the end of the day, I think my hope as we go forward is that if we're going to continue to see market rally or stock market price appreciation, that it comes not just from those 5, 7, 10 names, but from a much broader list.
Yeah, I think a lot of what I've been talking about with clients lately is, especially with people that may be looking to add new monies, is, just the idea that, where do we see the potential for growth here? We're looking at an environment that I think when markets are high, valuations are high. I tell people we're at the moment where for prices to go higher, we need justification. I think markets are going to need that to see that, and that comes in the way of earnings. That comes in the way of growth being better than expected, either on a macro basis or just on an individual company basis. So it's kind of a tough point, but that's where you're going to start to look for those underappreciated companies, like you say, in the small mid-cap space that has been unloved for quite a while now, surprisingly to a lot of people. And oddly enough, there is this effect called the January effect, which, as you and I talked earlier, it used to be something that was, so goes January, so goes the rest of the year. And while that was the case over a longer term look back, it hasn't really been the case for the last 2 decades, where the market's only averaging a few, 0.3% in January here over the last 20 years, while prior to that, including, going back 30, 40, 50 years, it's like 1.6%. But in that time span of maybe lesser returns, you actually saw small companies do quite well. So the hope is that maybe that, if people are a little bit leery, a little bit uncertain with a lot of different policy changes, new administration, everything like that, you're going to start to lean on things that, have maybe better value, maybe, less downside risk, and things that may be a little bit more stable.
We were in talking about the January effect. We were talking about this guide that's out there called the Stock Trader's Almanac, and it kind of summarizes some of those seasonality of market type things, whether it's the January effect or the sell in May or the Santa Claus rally. And I think it boils down to the fact that you can start to pick up on some of those patterns over time, but once they're published, once they're out there, one of two things happen. Either they break down entirely because everybody knows they exist, or two, if there's really a reason behind why that might be something that's going on, people start to front run it a little bit. And so sell in May becomes sell in April because you want to be out before everybody else starts getting out. And
Santa Claus didn't come this year?
And Santa, we got a little bit of time, but I think, when you
maybe
look,
it's not too early.
Yeah. when you look at some of those kind of broad rules or rules of thumb, I think it's important to understand that, they don't really speak to longer term what we're actually paying attention to. And again, Tom, you point out earnings are kind of the key here. We have a market that has been pretty favorably priced. It is not cheap by any measure. I think investors very much see a large potential for growth on the earnings front. And so as we kind of look ahead to 2025, I've been kind of piecing through the outlooks that are out there and trying to figure out those that are optimistic, what are they optimistic about? Those that are pessimistic, what are they pessimistic about? I think the big one for me is most of the optimists see pretty strong earnings growth. And if you're going to get back to a more typical valuation, more average prices for the S&P, you get there one of two ways, right? You get there either by increasing the E, the denominator in your price to earnings. More earnings means that today's prices look a little more favorable. Or the reverse, the bear case, well, you see the price correction, and that brings the price back down to some more normal level. But I think, Tom, as we kind of look to 2025, there's plenty of things in both kind of the bull case and bear case that maybe point to, okay, what are some of the things we should be watching out for, both on the upside and the downside?
Yeah, I mean, heading into this year, again, I think it's easy to look at the earnings forecasts, which I think are projected out by FactSet at about close to 15% earnings growth. We're looking at almost 5.8% revenue growth. That's compared to 2024, where we only saw 9.5%, Joel, if I'm correct, reading your numbers right, earnings growth, and about 5% revenue growth with respect to earnings. So, I mean, what Bob Landis would always tell you, look at interest rates and earnings for some idea of where things may be going. And, we have that case. The one wrinkle in that is the interest rate piece now. I think a few months ago, 5-6 months ago, I was feeling pretty good that, hey, we're on a pretty steady downward path for interest rates, and that's, again, can be favorable for pushing up asset prices. Now that's kind of up in the air. We've seen, bond fixed income markets now pricing in a little bit more potential for risk, a little bit more potential for inflation, as investors rightfully want to be compensated for that potential that's out there, that there's a shock or perhaps a higher inflation. So that is, kind of the bear case. I think you could see if some of these more stimulative measures come through and kind of fuel that fire, that maybe people are doing. It's hard to say. I always kind of half laugh at saying, like, well, we don't want people to do too well, right? It's going to cause prices to go higher. But that is a real thing, that if there's too much demand for the same amount of goods, that can cause prices to go higher. And that's become kind of the new worry. And I think the other thing I kind of look at is, well, if we look at a very severe scenario, what causes maybe our worst fear would be a bear market, right? Something more down. It has to be something that we're not really calculating or figuring. It has to be something that surprises. It could be slowing. We've had steady, consistent outperforming numbers for the last couple of years, really, for economic growth, jobs, markets. That could be the one thing that just surprises us. We don't anticipate it right now. It's not in the numbers that we're looking at, not in the forecasted numbers, but maybe us in the global landscape as being kind of the best economy out there. While you look at Canada, Europe, Japan, China struggling with growth right now, maybe somehow that trickles in, especially when a large number of our revenues come from outside the U.S.
And of course, no shortage of questions on politics. And I think the general answer I give is that it's going to be far more important to look at the actual policy that's being implemented. And of course, if you tell me what that policy is now, I'll tell you what I think is going to happen. We don't really have a great idea on policy implementation just yet. And so, there is this risk that you get a change in leadership, you get a change in power, and all of a sudden we feel like we all have to run the other direction, whether that's towards stocks or away from them, however you feel about maybe what's coming. And I think the reality is we need to be a little more diligent in kind of trying to digest what are the real policy changes and what are the implications of those changes going to be, because whether it's tariffs, whether it's labor market changes, whether it's regulation, I see some benefits from a business standpoint to some of those potential changes, just like I see some risks. And until I know for certain what policies are we actually even talking about and how quickly can we implement them, I think it's far too early to be talking about the impact they're going to have on markets. Joel, fairly modest week overall for economic data, but a big one that I've been keeping a pretty close eye on is that ISM Manufacturing Index, looking at the Institute for Supply Chain Managers and kind of what they see in terms of what's going on in the industrial space in our country. We've spent a considerable amount of time below what would be considered kind of expansion or growth in that part of the world, and yet, maybe things not all bad.
Yeah, I mean, and it probably speaks a lot to the resilience of the economy. As Tom was saying, I mean, the economy is a lot stronger than people give it credit for, and we've spent most of 2024 worrying about the economy and what was going on with it, and here we are. We're still doing pretty well. What was it, 2023, when everybody was predicting recessions, that the economy was actually going to sink into contraction, and that didn't happen. And hardly anyone's predicting it right now, which, of course, as Tom says, is...
Do we check the almanac?
And it's those meteors from outer space that we can't predict that come along and make those sorts of things happen. But the ISM Manufacturing Index looks at a part of our economy that's only, less than a tenth of our economy, but it's an important tenth, and it's been below what they consider an expansion number for 25 out of the last 26 months. That's a long time. But the recent number shows that it's the healthiest it's been in more than a year, and that it's close to that expansion number. It's as I said, it speaks to how we're still going along and adding jobs and being productive, even though manufacturing isn't firing on all cylinders right now.
And one of the fun things about the ISM numbers, both services as well as the manufacturing numbers, is that they include with it a bit of a projection for what it means for gross domestic product. Not sure how precise maybe some of those really track long term, but it is, I guess, encouraging that it still points to meaningful growth in the economy.
It shows this manufacturing number that came out correlates to a 1.9% annual rate of growth for the gross domestic product, and that's pretty healthy,
I'd say. And we get some housing data this week as well, some construction data that I think we've joked for months, if not years now, that the economic data continues to be mixed. Clearly, some of the housing data encouraging, some of it's still a bit more challenging. Things like the mortgage rate being as high as it is, definitely a challenge if you're looking to make a move on your housing. But at least from a sales perspective and a price perspective, a little more stable over the last month.
What was interesting this week is the National Association of Realtors said that they think prospective home buyers, are now settling in on having a 6% fixed rate, mortgage interest rate. And that's about where it's averaged the last 24 months, instead of hoping that it was going to go lower, which it hasn't been. So that says something about, if that's the case, that the demand for housing should start going up again, which should help sales. It won't help the pricing, but it'll help the sales.
Well, ideally, if you're willing to move out of your 3.5% or 3% mortgage home because you need something bigger or you want something different, it means the house you're in now probably goes up for sale as well. And so that ideally frees up the market a little more. Some of that gridlock we've seen that's maybe kept supply down will start to open up and maybe make life a little easier.
That's the whole conundrum, is the supply, and there have been some improvements in that over the last few years. There's a lot of housing still under construction, but we're woefully behind since the Great Recession.
And I think it is one of those that when you have an entire industry that was disrupted the way that the housing industry was disrupted coming through the Great Recession, really, in many ways, the cause of much of the pain that we felt, well, it's no wonder that we're still maybe leveling from all the pain that was caused. You add in the shock we saw to the kind of expectation for mortgage rates. Yeah, it's one thing when you bought your first home at 11, 12, 13% that now you can get it at 6%. It's another when you were looking at 3 or 3.25% a couple of years ago, and now all of a sudden you're talking about 6.5 or 7. Feels a little more painful.
Another major number this week was looking at the home price increase year to year, and that's now narrowed to a 3.6% increase year over year, and that's the lowest that it's been since September of 2023. And it's very small compared to what it has been, earlier in this decade, but it's still outpacing overall inflation, which is 2.7% right now.
Yeah, and again, I think as we come into a new year, doing so at a time in which the economy is still on solid ground, doing so at a time in which the things that we should be paying attention to from an economic perspective, good, not great, good, not bad the other way. And I think, that's maybe what we can hope for as we enter some uncertainty about some of the other stuff we're talking about is, we're coming at it from a solid foundation. One programming note for the markets next week, as a result of the death of Jimmy Carter, stock markets will be closed on the 9th of January, Wednesday the 9th. Some markets still open. And so as we look to a National Day of Mourning next week, know that certain activities we might otherwise be conducting.
Thursday the 9th.
Thursday the 9th, thank you, yes. With that, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.